with school of choice, it could be even other public school systems.
Yep.
So the question that was put out was, who are the competitors to our school district? Technically, they would be charter schools, parochial schools, private schools, technically homeschooling as well. But unlike the business world, they don't. There's no threat of hostile takeover. So you can't take over the public school system. So that actually isn't a way to solve the agency problem in the public schools, unfortunately. So it doesn't translate.
In a different way. Something that is right for me may not be right for you. That's why a set of rules or laws is used to define the right thing. Everybody has to follow the rules or laws. The examples of unethical behaviors include misleading financial forecast, insider trading, fraud, excessive executive compensation, and bribery. Companies should avoid unethical behaviors because negative publicity often leads to negative impacts on a firm. Alright, that's all for this video. Thanks for watching. See you in the next one. Bye.
So the last little bit is just about 6 minutes on key financial statements.
Strip away what you know about trading and take on Wall Street with the transparent strategy that every profitable trader knows.
Sorry, buddy, we're taking on
Hey
the school
guys,
system.
I am Deric. Welcome to my channel. In this video, I'm going to introduce to you the key financial statements. There are two key financial statements we use for conducting financial ratio analysis. First, income statement, also known as profit and loss account. Second, balance sheet. For accounting, we apply accrual basis for reporting. Accrual basis means revenues and expenses are recorded when the transactions occur, even though no cash flow may have occurred.
So going back to the last lecture series when we talked about this, so that accrual basis, when we were talking about the car dealership and we were talking about accounting versus finance, that was the accounting side of things, where in the ledger, despite the fact you haven't collected money for the car you sold, still shows that you're in profit because you're going to get that money eventually. So that's the accrual basis and the tie into the last series.
So, profit shown in income statement is not the amount of cash we earn. In income
We might not have it
statement,
yet.
we have included some non-cash items as well, such as depreciation. We don't really pay for depreciation. That's why net profit is not cash. Accrual basis can better measure the profitability of a company during a specific time period because it records the business activities based on the dates of transaction. Alright, first, let's look at the income statement. The income statement provides a financial summary of a company's operating results during a specified period. All the figures shown in the income statement are on 1-year basis. Revenue for 1 year, expenses for 1 year, and profit for 1 year. For the format of the income statement, report revenues first, then deduct any expenses for the period. If we put it as an equation, it will be net income or net loss equals revenue minus expenses. If the end result is a net income, company may have two options. Either the company pays dividends to shareholders, or to keep the net profit as retained earnings. This picture is a sample of the income statement. The operations section of the income statement reports the firm's revenues and expenses from principal operations. It starts with sales revenue. Less cost of goods sold. Cost of goods sold is the direct cost of production, such as material cost and labor cost. Then you will get gross profits. Less operating expenses. Operating expenses are the indirect cost of production, including selling expense, general and administrative expenses, lease expense, and depreciation expense. Gross profits less operating expenses, you will get the operating profits.
Okay, so I'm going to stop this just so that we make sure that we kind of have this well understood. So first you take in how much money did the company take in for selling all of their goods. You have to subtract the cost it took to make the goods themselves and or what it took to transport the goods to the
Cost of goods sold.
Yes, thank you. This is cost of goods sold. But that's essentially basically what it takes to get said goods to made and to the consumer.
Yep.
Then that's your gross profits. But then you have to start deducting things to get your net profits. And so you have to start taking away things like the operating overhead, which includes things, including things like the lease, as well as depreciation of whatever you happen to have, that you happen to be selling. When you have gotten rid of all the operating overhead, you've basically got the operating profits at that point. And that also goes by a different name, which is called the EBIT, or
Operating profits is also called earnings before interest and taxes, EBIT. EBIT less interest expense, you'll get EBT, earnings before taxes, or net profits before.
So EBIT is earnings before interest and taxes. Then you deduct the interest. So then you're left with the earnings before taxes. So that's the EBT.
Taxes. EBT less taxes, you'll get EAT, earnings after taxes, or profit after taxes. EAT less preferred stock dividends. The final item is earnings available for common stockholders.
So the idea then is, remember, we have to say to ourselves, okay, after you factor in taxes and after you've taken care of the interest and you're left with that balance, what do you do with it? You can give some of this as dividends to your shareholders, or you can keep the rest and reinvest in the business.
Usually, we call this as net profit.
That's the net.
At this point, company may decide how to use the net profits, either to pay out as dividend to shareholders or keep it as retained earnings. Next, let's look at the balance sheet. The balance sheet presents a summary of a firm's financial position at a given point in time. We just mentioned the income statement is prepared only for 1 year. But for balance sheet, it is for all years, which means it includes the records accumulated from the first year the business started until current year. Total assets equals total liabilities plus stockholders' equity. The meaning of this equation is important. For holding the assets, including inventories, receivables, and fixed assets, company can generate sales. When the amount of assets increases, at the same time, liabilities and equity will increase. For buying the assets, the company may borrow money from the bank.
So what's important about that, though, is when total assets increase, total liability plus stockholder equity must necessarily increase. But your goal is to limit your total liabilities so that a majority of that total asset increase is actually stockholder equity that increases. So your goal is actually, the assets go up, liabilities stay as level, or try to bring them down if you can, and bring up that stockholder equity as much as you possibly can.
Borrowing is a type of liabilities. The company may also issue shares to finance the company. That's the part of equity. Please take note, the transactions in balance sheet are recorded at cost price, which is the original purchase price. So, the book value of a firm may be very different from its current market value. A company's balance sheet is comprised of assets, liabilities, and equity. Assets are the things that a company owns and that have value, or something that will be received and can be measured objectively. It consists of current assets and long-term fixed assets. Current assets include the short-term items that are convertible into cash within 1 year, such as cash, accounts receivable, and inventories. Accounts receivable means the amount of money that you have not collected from the customers after selling the products.
But you're going to
Another
get
part, the long-term assets or fixed assets, are the items of a more permanent nature, such as property, plant, and equipment. Current assets plus fixed assets, you will get the total assets. Liabilities are the money that a company owes to others, such as creditors, suppliers, tax authorities, and employees. They are the obligations that must be paid under certain conditions and time frames.
overhead.
Current liabilities are the short-term obligations due within 1 year, including accounts payable and short-term debt. Accounts payable are the amount of money that has to be paid to the suppliers after receiving the products from the suppliers. For the part of long-term liabilities, these are the obligations due beyond 1 year. For example, company borrowed money from the bank to purchase a property. The borrowing from bank is classified under long-term liabilities. Current liabilities plus long-term liabilities, you will get total liabilities. The stockholders' equity represents retained.
So short-term debt, which is current liability, plus long-term liability is total liability. Just like current assets and long-term fixed assets makes total assets.
And funds contributed by its shareholders. These include preferred stock, common stock, and retained earnings. Stockholders accept the uncertainty that comes with ownership risk in exchange for what they hope will be a good return on their investment. Putting these together, total assets
One more thing to stop there. So the idea here is that you buy in your stock at a fixed quantity, but if you can keep your overhead low and you can increase your long-term assets, that then increases the stockholder equity, meaning that the shares that you bought. So, for example, on the stock exchange market, when you see those shares go up, that's because they have increased their assets greater than they have increased their liability for that company, and so the rest comes back to you.
In theory.
In theory, right? We're talking very idealized.
I was going to say, stock, as someone who spent 10 years in the market as a branch manager, I'll tell you that markets are always anticipating 6 months down the road. So if a company comes out with a new product and they expect it to be very profitable, they'll look at the next 2 quarters and say, what are the future earnings from that product? How will that impact their earnings? So they're always looking forward-looking.
But if we were to take a very basic idea and we were just to do mathematically what it was, it would be mathematically this way. But you're right, with speculation, then that also complicates things. It drives the market. Exactly.
Equals total liabilities plus stockholders' equity. This is a sample balance sheet of a company.
Oh,
All right,
hold
that's
on,
all
I'll
for
pause
this
that so
video.
that can
Thanks
be
for
put back
watching.
up.
See you in the next one.
Okay.
Bye. Accounts receivable
Let's put this
means the
back
amount
just
of
so I can
total
leave this up there
liabilities
for people
plus
to see.
stockholders' equity of a company.
Okay, so here you can see here, on the left-hand side, you can see the assets. You can see here, there's the current assets. So for over the year, what this company is going to make, what they made in 2005 and 2006. You can see their fixed assets, and that was at cost. So it may not be the current value now, but when they got it, what was the value and what it comes out to be. Now, interestingly here, they've also put something that they didn't talk about, and that's depreciation. So they said less depreciation, and that fixes the at cost value for what the current value of their long-term assets are. So say, for example, I had a machine that would build me flags. But that machine is now 2 or 3 years old. And as a result of that, I wouldn't be able to sell that for nearly what I got it for initially. That's the depreciation. And so that means that your total asset value has decreased. And so that's also factored in here under less accumulated depreciation. Now on this side, on the right side, you can see the liabilities and the stockholder equity. The current liabilities for accounts payable, notes payable, so basically your yearly overhead, and then the long-term debt. So things that would be paid off like loans to the bank over a long period of time. What's left over then is the stockholder equity. Now, in this case, things like preferred stock, common stock, which is going to be talked about in later series, as well as the retained earnings, what you have after you have deducted that away. Questions about all of this stuff? That's pretty much it. So that's all for today. Thank you so very much for sticking with me on this one. And then I'm going to pass this, so the post-lesson to try and consolidate things. This stuff is open book, and I do want to, and I'm very, very grateful. We had a really lovely discussion. So I'm going to pass out the prizes for all the discussion because we furthered each other's knowledge by improving our collective knowledge here. So that's all I got for this time. Thank you, and I'll see you most likely next week. Bye.